You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everybody. Welcome back to yet another episode. Welcome, Hamish. Hamish, how you doing?
I'm doing well. Another relatively uneventful week in Melbourne here.
Yep, just keeping up with your lockdown.
Yeah.
Has it loosened at all or not really?
Yeah, they're going down slowly. So I guess we kind of just got to see what happens. But yeah, another week in full lockdown, which is very, very exciting, of course.
Is it still only an hour that you're allowed out?
An hour? I don't know if it was ever the case that was it? Maybe it is.
I thought it was like you're only allowed out of your house for like an hour or something.
Oh, okay. Well, you're allowed out once per day. Maybe it is for an hour. I don't know. I'm not sure. But yeah, it's very limited. How's things at your end?
Yeah, things are going well. Same old. Just making lots of YouTube videos.
Yeah, you've been...
As I do.
You've been cranking them out 3 a week at the moment.
3 a week, yeah. It's... Yeah, but I enjoy it, It's what I love doing.
That's good.
Yeah. Anyway, we should get stuck in. We got a special podcast today. Me and Hamish, over the last however long, many podcasts have been saying how we would like to know more about economics. Because it really, when it gets down to the nitty gritty, that is one of our weak topics. So we've brought on one of the biggest brains I know, and that is Jason Hughes. Jason, How you going?
Not too bad. And you guys?
Yeah, going well. Thanks for coming on and agreeing to do this and talk all things economics with us today.
No worries.
How long have you been studying this for?
So I'm just about to finish up my degree in finance and economics.
Yeah, right.
I've sort of focused on banking and risk management through that. So I've got 2 units to go, and they're just sort of ones that I were the boring ones I didn't want to do throughout the year. So that like I've effectively finished the meat of the degree, and it's just those sort of waste of time ones that I've got left. So about 4 years or so I've been formally studying economics.
Awesome. And you've been podcasting all through the way now, which you've recently pulled back on because of your new project. Do you want to tell us about your new project?
Yeah, so the new project is an email newsletter that I send out twice a week. I did have a couple of podcasts going, and they sort of wrapped up 2 or 3 months ago.
Yeah.
One of the hosts decided he was going to go and do some other stuff, and then I decided I wanted to try and sort of put my thoughts into writing rather than talking about them. It's just another skill, I guess. So it's called Inbox Condensed. You can find it at inboxcondensed.substack.com, and every Wednesday and Sunday I send an email about sort of usually based around the things that I've been reading. So whether that's articles, those are usually in the Wednesday emails. Yeah. Articles I've been reading, things that have been happening, and then on Sunday I focus it on sort of a bigger topic, whether that be politics or economics or something happening in finance, and sort of write up a little bit of a longer explainer on a Sunday.
I like it because I think that's... Sorry, Hamish.
No, you go.
I was just going to say, I think that's something that people need. There's so many different news topics thrown at us. So I think an idea like Inbox Condensed is actually a pretty smart idea.
Yeah, definitely.
And you've only just started that up, right?
Yeah, so it's been going for about a month and a half now, I think. So I've just been writing. I think on Sunday I wrote one about the politics of vaccinations and sort of some of the history of vaccinations and why we have certain vaccinations and not others, some of the economic reasons behind that and stuff like that.
All right, cool.
Awesome. Yeah, well, I'm certainly interested to pick your brain today because I don't know how many times on this podcast that we've been discussing some kind of economic situation, news story, and I've just been like, well, I don't really know what's going on here. So it'll be interesting to get to the bottom of a couple of those things today. And I guess should we just start by going through maybe a bit of a brief overview of economics and what's involved?
Yeah, sure. So economics basically is studying how we produce and allocate sort of resources.
Right.
Is sort of the textbook definition that you get. But it's basically the study of everything that's going on. And it intertwines with politics. It intertwines with basically everything. Everything we do can be studied from an economic point of view. And so in modern day economics, we tend to split that up into macroeconomics and microeconomics.
Right.
And so macroeconomics is what most people think of as economics. So thinking about things like the GDP and unemployment and things that the government is going to worry about. So when you hear people say, this government's terrible economic managers, they're talking about macroeconomics, right?
Right.
And then microeconomics is it's a more modern approach to thinking about economics. It looks at things from the bottom up. And so you're looking at an individual person and how they are going to go about making decisions about what they do economically. And so that's where you get sort of things like when you go into a shop, what are you going to buy? How much are you going to pay for things? And that's where a lot of modern economics, there's been a lot of modern economists, have done a lot of work on like, how do you set the price for something? So in a shop so obviously, there's the classic, you said something at $2.99 and people think they're paying $2, but they're actually paying $3. So those are the sorts of things that come under microeconomics.
Right. Okay. So like macroeconomics is more like a top down and micro is more of a bottom up kind of view of things.
So that's sort of the way that things would have been looked at probably about 20 or 30 years ago. Obviously, economics is something that's constantly evolving and there's constantly people publishing papers and things. And so in the last 20 years or 15 years, with the more powerful computers that we have now, we can actually start to combine microeconomics and make big macro models. So you can like run a simulation with a bunch of individual agents running around doing things, and then you can explode that out into a macroeconomic model. But there's sort of just different, like either looking top down or looking bottom up.
Yeah. Okay. And so I think it's quite confusing for people to even kind of know where to begin looking at economics, whether it be micro or macro. Like, I don't know, for someone that wants to start learning a little bit more, what's kind of like a good starting point? What are some good kind of basic principles to kind of get under your belt to start to understand the profession economics a little bit more?
Yeah. So I think the best way of thinking about economics is inputs and outputs. Okay. And so the way basically everything in economics is you care about some things, let's just say unemployment. And then the economist's job is to determine what things affect unemployment. Right. And so if we want unemployment to go down, what things do we need to do? And so that's probably the best way of approaching it, is taking a topic like unemployment and then having a look into what are the things that are going to change it. Then sort of that'll work you back into your inputs. So, for example, unemployment, things that are going to change that are, one, sort of government spending. In the modern day where we've got these sort of high-skilled jobs, certainly in the developed economies of Australia, the US, and Europe, you've got these sort of these jobs that require a high level of skill. And so government spending in things like education or practical training and those sorts of things are going to affect unemployment because you're going to have more people who are able to do the jobs.
Right.
And so it's sort of that sort of path of saying, what do I care about?
Yeah.
What do I want? Which way do I want that thing to move? And then how can whoever needs to do the thing, how can they affect it?
Right. Okay.
And usually that's going to come back to the government.
Yeah. Unemployment's an interesting one at the moment, right? Because there's a lot of, in Australia at least, we've had some government programs, some government spending that's allowed the unemployment rate to not go out of control, as we've seen in some other places. JobKeeper being one of the levers that the government's been able to use in order to keep people employed during this process while businesses are struggling. And we've kind of not seen that do as well, in countries like the US, where unemployment has risen substantially. So I guess that's kind of an example of what you just described, where government spending can have an influence on the level of unemployment.
Yeah, absolutely. And that's sort of, it's a big debate currently, obviously, in economic circles of these wage subsidies. We have seen them in other places in the world. The UK did a wage subsidy program that was fairly similar. There's a couple of places in Europe that did it as well. So you've seen, in that case, you've got a wage subsidy, which is government spending, has kept unemployment low. Now, the question is that unemployment going to stay low after the wage subsidies are removed? Like sort of when we move through through sort of the main lockdowns and whatnot, and you remove those wage subsidies, are people suddenly going to get laid off? And there's certainly worries about that happening here in Australia, because the JobKeeper program is only available to part-time and full-time employees. It didn't cover casuals. And the problem with that is that while people were getting paid JobKeeper, they were accruing leave, so annual leave and sick leave. And so the problem is a lot of people have gone out, they've been getting JobKeeper, but they've been able to go and find other jobs. And there's sort of a lot of fear in economic circles at the moment that once JobKeeper gets removed and people leave, you're going to have these businesses, and some of them are just small businesses, who have to suddenly make these big payouts of annual leave. And that might crush a whole range of businesses. They might just go bankrupt.
Yeah, and I guess
complex problems.
Yeah, and I guess it's not necessarily the case that once we're out of lockdown, businesses are just going to go back to how they were performing previously. People might be less reluctant to go out and spend as much as they were previously. So even though right now we're kind of in this artificial place where lockdown is restricting people from spending money, it's also not necessarily the case that people immediately go back out afterwards. Businesses might find them, I think it's very likely that businesses will find themselves performing substantially worse than they were previously, even after lockdown's finished. And that's also surely going to have an impact on their ability to employ people that are currently on JobKeeper.
Yeah, and there's obviously the issues of, you've got these businesses which they're trying to fix it now, but some people are getting paid like 3 or 4 times the amount that they would normally earn.
Yeah, I'm one of those people, actually.
Yeah, I know a number of people who are in that situation. I know a number of people who have been able to get double the JobKeeper, like from 2 different jobs, which is not supposed to be allowed.
Wow, that seems whack.
But it's been very, I know there's a number of flaws with the system, but I mean, that comes with any kind of quick implementation of anything. So
yeah, that's what I was going to say. I guess that's an interesting thing to factor it. Like, this is a complex economic issue, but you can see that it's imperfect just by the fact that it had to be done very quickly. So you're going to get some flaws that don't work entirely as what we would like them to. But I guess that's like what Ray Dalio was saying in a recent interview, is that it's just the government governments around the world trying to get large sums of money to their citizens in an imperfect way. So
Yeah. And you think about it, like, if you need to put money into people's bank accounts and you sort of set these boundaries of these people are eligible for it and these people aren't, you need the infrastructure to do that. And luckily here in Australia, we have a very good infrastructure through things like the ATO has a very robust payroll system, a payroll tax system. And so that was a very easy way of putting money into people's bank accounts. Whereas in like the US, they just don't have that same sort of infrastructure built. And so it was much more difficult for them. I don't even know if it would be possible for them with their infrastructure to provide like a payroll subsidy like we've had here.
Right.
Like it just wouldn't be possible to do.
Right.
And so that's another like sort of side of economics. You can debate the policies to the nth degree, but there's a practical side to it as well.
Yeah, getting it done.
Yeah.
Yeah. No, that's very interesting. All right. Well, so we were talking before about economics, and the easiest way to look at it, I suppose, if you're just kind of getting started, is inputs and outputs. So when we're looking just, thinking about the macro, thinking about the big picture, what are some of the inputs and outputs that we're typically looking at to get a better understanding of how maybe our economy, say here in Australia, actually works?
So there's the big three outputs that we talk about, the GDP, unemployment, and inflation. So those are sort of the headline outputs that we care about.
Key figures.
Yeah. Right. And the reason we care about them is because they tend to be good indicators of a range of other things that that we care about. So
it's like an umbrella.
Yeah. So generally, if GDP goes up, people's standard of living is going to go up, and their healthcare outcomes are going to go up, et cetera, et cetera. If inflation is in a reasonable range, you're not going to sort of have instability. GDP is going to go up gradually over time. And then obviously unemployment, if that's at a low enough level, it's going to drive GDP the way we want it to go. Inflation's going to be in about the right range. And of course, people are going to have jobs. And when you're talking about the macro, obviously by definition, you can't talk about each individual person. And so that's why you sort of care about these three things, because they're generally going to keep each person in a pretty good state if they're in the right place.
Right. It's probably, it's the best way to get the broad picture, I suppose.
Yeah.
Yeah. Okay.
All right.
So I suppose it's the same way you talk about in when you're talking about stocks, you're going to look at sort of like a debt to equity ratio or a PE ratio or like things like that. Like they're not the whole story, but they give you a pretty good indication.
Yeah. Okay.
Yeah.
All right. Well, so those are the three primary outputs, right? Could we maybe talk about what are the two? What are the inputs in that equation? So
there's sort of two main ways of affecting the economy. There's fiscal policy and there's monetary policy. And the way I like to think about it is fiscal policy is the remit of governments. So governments take care of fiscal policy, and monetary policy is the remit of the central bank. And there's a fuzzy line between what the central bank is and what the government is, and it's a very important
because they're
concept.
intertwined, aren't they?
They're very intertwined, and it's a very sort of important concept of like this thing what we call the independence of a central bank. So the idea is that they're set up by the government. In some places, they are owned by the government. Here in Australia, they are largely owned by the government.
Okay.
But generally what you want is you want no direct control over monetary policy by the government. But it's a difficult sort of balance to draw. But sort of coming back to fiscal policy, when we think about it, we're thinking about government spending. So anywhere you see government is committing this much to build this infrastructure or to build out their defense force or
roads and infrastructure, healthcare, that sort of stuff.
All of those things, that's government spending.
Right.
And then tax policies as well. And so you can it's this sort of give and take between spending more to inject money into the economy, or you can tax less so you don't take as much money out of the economy.
Right, okay.
And so what we see here in Australia, we see low and middle income tax offsets. So if you're earning below, I think like $37,000 or so, you're getting about $600 a year from the government, just free and clear.
Right.
And Australia is also, I think, one of the few countries that has a tax-free threshold as well.
Yeah.
Is that correct?
Yeah. I'm not sure about what other countries have. I'm pretty sure that the US in large parts of the country don't have a tax-free threshold. They get taxed on a state and federal level though. So it would be a bit difficult to go and like check all of that. But yeah, we've got the tax-free threshold as well. So if you're earning below $18,200, you don't get taxed.
It's a pretty good rule.
Yeah, it is a good rule. And
handy for the low income earners. Yeah.
It's handy for the low income earners, and it's also less of a stress on the tax system, because if you're taxing 20%, sort of below $18,200, that really doesn't matter. Like how many people in the economy are earning below $18,200?
It's a small amount of money to be chasing.
Yeah.
Yeah.
And then you've got to worry about like some 14-year-old who's working one shift a week at their local Woolworths. Like you don't need to worry about them doing their tax return.
True. Yeah, right. Yeah. Because the top tax bracket, I would presume, pay in terms of dollar amounts, contributes a substantial majority of the overall tax revenue generated. So if it's a trade-off between having a tax-free threshold for the very low earners or increasing that top bracket by a couple of percent, I'm sure that's a pretty easy decision to make.
Yeah. And then it just means that, because remember the tax system has to be administered by the ATO. And so the ATO need to employ people, and they need systems that are going to track people and see where tax evasion is happening. And you'd rather catch that at the top than at the bottom.
Yeah. Yeah, definitely. Yeah. And it's probably a safer policy from a government too, because I imagine there would be more voters in the bottom, tax bracket than what there would be people in the top tax bracket.
Yeah.
True.
Yeah.
And then the other part of that is we've got a very good sort of social security system here, where if you don't have a job or you're a low income earner, you can get money from the government. And most of those people are going to fall underneath that tax bracket, because that money is actually taxable. So if you're earning above $18,200 and you are getting money from Centrelink, you'll actually be taxed on that money. And so most of those people are going to be below $18,200, which means that
makes sense.
Like those are the people who aren't going to have money left over at the end of the year to pay tax.
Right. Okay.
Right. So we've got this. So fiscal policy is stuff that's done by the government.
Yeah.
So it's them, first of all, collecting money through taxes, and then the policy on how they spend the money, whether it be on infrastructure, healthcare, or roads, or, defense or whatever.
Yeah.
And then so there's that.
I'll just jump in there. So
go. Yeah.
They collect taxes and they spend the money. They can spend more money than they collect. And to do that, they need to borrow.
Okay.
And
where does that money come from?
So that money comes from the market, basically. So here in Australia, we have the Australian Office of Financial Management. So if the government needs to borrow money, generally it's going to be the Office of or the Department of Prime Minister and Cabinet. they're going to go to AOFM and say, look, here's our policies. We need to borrow $13 billion. And the AOFM is going to basically just issue bonds, and they're going to, through generally a bank. So I think Westpac, I'm not 100% sure, I think Westpac do their banking, are going to just offer those bonds to the open market. And there'll be an auction and people can put in their bids for it. And then they'll divvy it up, just basically like an IPO.
Right. Okay.
Okay. Yeah.
So that's what happens when people are buying bonds.
Yeah.
Right.
So this year we've had a series of auctions. They've all been very, very oversubscribed, which is a good thing because people want Australian government debt. I think Australian government debt is one of the highest rated in the world. It's higher rated than the US government.
Oh, wow.
Wow.
And so I think the US government has AA rating. We've got AAA, or it might be we've got AA and they've got A. But we're higher rated than the US government. People want our bonds. And so if the government needs to borrow money, they can, just sell bonds in the open market. Just like if CBA wanted to borrow money, they could sell bonds in the open market.
Mm. Right. So if you're buying government bonds, you are buying into the debt of the government. So that money is being given to the government for them to be able to spend it on whatever they need to do.
Yeah. So if you're basically lending your money to the government,
and then
they're
like
promising
any
to pay
debt,
you back.
They'll pay it back over time.
Yeah. So they'll pay it back over time with interest.
Plus interest.
And obviously bonds are slightly differently sort of structured to a mortgage or something, where you only pay the interest down over time and then you pay the principal right at the end. But they're paying it back to you over time.
Right. Okay. Right. And if the government, this is a question I've always wondered, if the government is doing a ton of spending like they're doing now and presumably taking on a lot of debt, issuing a lot of bonds, does that have an impact on the interest rates on those bonds? Do the interest rate on those bonds go up when there's a huge supply of them being pushed into the market?
Yeah, absolutely. So if there's low supply and also if there's very high supply and very low demand, the price of that bond is going to come down. And therefore the interest rate is going to go up. And so luckily here, we haven't really hit that point. And in a lot of countries, we don't really know where that point is, where suddenly the interest rates are going to go up. But as long as there's sufficient demand like we have here, it's not going to happen because it's totally a supply and demand thing.
Right. Okay.
And so the way that works, is when the AOFM makes a bond, they'll say, okay, here's a 10-year bond with semi-annual coupons, so paying interest every 6 months, and we'll pay that at 2.5%. And then they'll go to the market and say, here's the bond, semi-annual coupons, 2.5% for 10 years. And the market will say, we want 3%, so we're just going to pay less for that bond. Mm-hmm. So we're going to pay below the par value, basically.
Right. When it comes to governments, we're talking about how Australia's bonds are quite highly rated.
Yeah.
So if the ratings slip down, does that mean people are less interested in buying that debt?
So the ratings are done by like private companies. So there's some big private companies around the world. So Fitch, Standard & Poor's, or S&P, and Moody's. Yeah. So they are the three big ratings agencies, and they will do ratings of bonds. So they'll have their model that they basically every quarter or month or whatever it is, they will just sort of put recent data, and it'll include like a range of things like GDP and unemployment and the budget surplus and a range of data, and they'll plug all of that into their model, and then they'll get a rating out of it.
So what does the rating actually tell us? Is it how likely that government is going to be able to, repay its bond or something?
Basically, yeah. It's like a person's credit rating.
Right. Okay. Yeah.
And so
it's saying this is a safe bond. If it's say a AAA,
Yeah.
you're like, okay, this is safe.
Yeah. So
Right.
if it's AAA, all the way down to I think B, that's what you call investment grade.
Okay.
And so investment grade bonds are, it's more of a legal definition for something like a pension fund or a superannuation fund, because they'll only be allowed to buy investment grade bonds. And so you've got that, and then below B, you're going to C, which is what you call a junk bond, or a high yield bond is sort of the more politically correct way of saying it. And so generally it's going to mean obviously they are yielding higher. So you'll get a better interest rate, but there's more risk attached to it. And then once a bond goes into default, it gets a D rating.
Right. Okay.
So are there some countries, because I imagine there are some countries out there that their bonds would not be particularly highly rated. Does that mean there are some countries out there that really struggle to get investors to buy the government's debt and struggle to raise money and struggle to spend on, the things we were talking about before?
Yeah, absolutely.
Right. Okay.
So like a recent example is Argentina actually defaulted on their debt. Earlier this year, actually. So they defaulted and their bonds are useless. And so I think their Argentinian bonds are yielding about 40% or something.
40?
Yeah, at the moment.
Holy smokes.
So they are...
So that's saying like if they don't default on those bonds, then the Argentinian government's going to give you 40%.
Yeah, basically.
Wow.
So basically what they did is they restructured their debt. And so effectively things like the IMF came in and the World Bank, and they sort of restructured it all. It's very complicated and like a highly political thing. But basically, if you were to buy a bond now, an Argentinian bond, I just had a look here, I think this is a 10-year bond, is currently yielding 51.58%.
Right.
Wow. So if you were to buy one of those bonds now and hold it until it matures, and then they don't default, you'll get 51.58% yield. Importantly, that's in pesos. So the peso is going to change very significantly against the US dollar or the Australian dollar.
Yeah, that's what I was just about to say. How does inflation must play a role in that, right? Because the 50%-ish interest rate is probably a nominal interest rate, I presume. And then once you take into account inflation, what the actual interest rate that you earn over that 10-year period may be very different, right? I mean, if a bond was had a 2% coupon attached to it, or a 2% interest rate is what you're going to get over the next 10 years, but the inflation rate is 3%. In real terms, you've actually seen a negative 1% return. Have I got that correct?
Yeah. Yeah. Well, it's not exactly that, but that's a very good approximation. Just because of like compounding effects.
Yeah, of course.
So just quickly, I Googled 2018 inflation in Argentina was 34%, and 2019 was 53%. So like you're basically getting zero on that.
Right, I see. So overall, you have these, in the case of Argentina, this high interest kind of bond. Is that they have to offer that high interest because otherwise no one would be interested? And that's the natural interest because of the supply demand equation.
Yeah, so that's going to be set by the supply and demand equation. And so it's sort of like tricky when you're offering bonds, they need to be offered at a reasonable approximation of what the market is going to want. So you have to sort of estimate how much the market wants. Is willing to buy, and then like what terms they're going to want. But then once it's in the market and they've like they're just trading on the open market, then it's 100% just dictated by supply and demand.
Right.
And that's
So it can
where
swing.
modern central banks can adjust interest rates just by buying and selling government bonds.
Right. That's a good segue.
Yeah.
Because that's the next thing we've got to talk about, right? So we spoke about fiscal policy. That's what the government's doing, what their, tax revenue they're collecting, what they're spending it on. And then we've got this other input, which is the monetary policy.
Yeah.
Right. So tell us about what is monetary policy? What is a central bank? How does that all relate into this picture that we're starting to kind of construct?
So monetary policy is what it says on the tin, really. It's the policies set around the money in the economy.
Okay. How much money's in the economy and that sort of thing?
Yeah. How much money is in the economy, how much that money costs, because an interest rate is a cost for money over time.
Yes.
So it's related to that. And then sort of the part that people don't pay attention to a whole lot, or is sort of a little bit more hidden, is how do you move money around the economy? And that's a very important role that the central bank plays.
Okay.
And so like effectively the payment system within the economy. And the stronger that payment system is, the more effective monetary policy is going to be. So I don't know if you've ever looked at, for example, in the US Fed, when they set not an inflation target, when they set their cash rate target or their interest rate, they set a range of 0.25%, whereas here in Australia, we just set one interest rate.
A number.
Yeah. So that's got to do with the fact that Australia's payment system is a lot more robust than the payment system in the US. And so when the Reserve Bank of Australia sets an interest rate target, they can actually hit that target. I think since they started targeting the interest rate, because they haven't always done it, I think they started targeting the interest rate around the beginning of the 2000s. There hasn't been a single day where they haven't hit the interest rate.
There you go.
And so, but in the US, they just can't do that.
Yeah, can you explain that a little bit more? Maybe the difference in the payment system, what you mean by that in terms of the difference between the US and Australia?
Yeah, no worries. So in Australia, if you want to be a bank, you have to, or if you want to, it's not necessarily a bank. If you want to be an authorized deposit-taking institution,
Okay.
so you want to take people's money and hold it for them. You have to be registered with APRA. You have to get a license from them to do that. And then you have to be a part of the payments infrastructure with the Reserve Bank of Australia. So you have to hold a bank account with them effectively.
Oh, okay.
Right.
And that bank account, in there you have your exchange settlement funds. And effectively what happens is at the end of the day, you'll notice obviously payments, if you pay from CBA to Westpac, it'll only arrive the next day. And the reason for that is at the end of the day, all the payments that get made, are all put in a list and they are sent to the central bank, so to the RBA. And the RBA will just adjust the account balances in CBA's accounts and Westpac's accounts on a net basis. And the way this used to happen was if CBA was sending money to Westpac, they would just basically send some sort of message to Westpac.
Right.
Usually, over time, there was different technology that this was done using. But they would just send one, and CBA would hold an account at Westpac, and Westpac would just adjust that account. And then once a week or once a month, someone would literally take cash or gold from the vault at CBA, and they would carry it over to Westpac and say, here's what we owe you.
There you go. And so now this is all done through now the Reserve Bank.
Yeah. So it's all done completely through the Reserve Bank now.
It all makes sense.
And the reason why that's important is because imagine if a bunch of CBA customers want to send money to a bunch of Westpac customers. CBA doesn't have all the money like that. They have in like their customer accounts because they're lending it out. CBA would fail. And then a bunch of people would like have their money wiped out. Right. And so this happens on a daily basis. And then the way, if they do run short of money in their account, they are then allowed to borrow. And they can say, look, we're supposed to pay you $10 million today. We don't have the money, but like, cause the money's sort of flowing to you, likely you're going to have to pay us a net amount tomorrow. We'll just say you pay us back tomorrow minus a little bit of interest.
Right. Okay.
And that happens within those RBA accounts. And so the way the RBA does this is they say, you're allowed to just make those deals. But any money you hold at the RBA earns interest at 0.25% below the published cash rate. If you can't find anyone to borrow the money from to settle your payments, the RBA will lend you money at 0.25% above the cash rate. And so nobody's going to ever lend below 0.25% below the cash rate because they can just put their money in the RBA and earn more. And nobody's ever going to borrow any higher than 25 basis points above the cash rate. And then all the RBA has to do is sort of buy and sell bonds so that the amount of money in those exchange settlements accounts means that the average rate that money is lent in the overnight market is at the cash rate.
Right.
Okay.
So we're getting high level, aren't we?
So effectively, that's how they do that. And getting back to your question, Hamish, and what happens in the US is they run a fairly similar system, but there isn't that rule that everybody has to be a part of the Federal Reserve System.
Oh, okay.
And so they don't have the same amount of control over how much people are borrowing and like where the cash rate is. They just can't, because not everyone's a member of the system, they can't control it as closely.
Interesting.
There you go. Wow. Okay. So going back, so the central bank is really the head honcho, I suppose, of this whole system, and is kind of observing everything and just making sure that it's controlling everything, making sure everything works. It's controlling the amount of money or credit, and all of the banks actually work through the central bank. Well, at least that's what we've got in Australia. Is that right? Yeah.
So the central bank really isn't legally. It's just a bank. It's just a bank. And in fact, the central bank until sort of the 1950s was CBA.
Okay, there you go. Didn't know that.
So they're just a bank. Now they get set up by a federal charter. And so they're sort of carrying out government policy in a way, but they're just a bank. In the US Federal Reserve System is a series of, I always forget, it's either 7 or 9 banks.
Yeah.
There is just a series of banks around the country. And then they have a board.
That's right.
Who sits in Washington and who sets policies. And so they're just that sort of, the way it was sort of developed in the economic school of thought is through a guy back in the 1860s, I think, a guy called Walter Bagehot. He was actually he was an editor of The Economist magazine, and he wrote this book called Lombard Street, in which he sort of laid out a model of a central bank where the central bank is just a lender of last resort in the banking system. So if a bank runs out of money, central banks there to lend it to them. And because banking is inherently unstable, and throughout history, banks have always failed. It's a really good system for running an economy, but it's also a really bad system because they fail.
So I'll chuck in a question. So can a central bank fail?
Technically, yes. We've never really been in the situation where a central bank has failed.
How would that happen?
So the way it would basically work. So if you think about a central bank's balance sheet, they're going to have assets, which is like government bonds, gold, maybe some foreign currency. They're going to have that on their asset side. And then on their liability side, they're going to have those exchange settlement balances. So the money that banks hold there.
What we were just talking about.
Yeah. And there's going to be currency because they're liable for the physical money that's going around in the economy. Though if those liabilities get really, really big and people suddenly lose faith in if the banks lose faith in the money that is in the economy or that they're holding at the Reserve Bank, the bank could fail in that case because people are just going to say, look, we want to take our money out. We want to go and get some gold with it, or we want to. And if people would have to say, we're just not going to transact with this currency anymore. We just don't have faith in it anymore.
So it'd be for a central bank to fail, it would be everybody bailing on that currency and just getting out and saying, "No, we are leaving."
Yeah,
and they're all doing this together.
A very specific way that they would do it. We've never really seen it happen.
Yeah,
you're more likely.
Sounds like we don't want to see it happen.
No, it would be. it would be very, very bad. In a big country, obviously, like for example, Argentina, people lost faith in the peso, lost faith in the government, and that would probably happen before the central bank failed. People would lose faith in the government first, but like if the Federal Reserve was going to fail, you would hope the U.S. government would bail them out because if the U.S. Fed failed, there's just an ungodly amount of money that's transacted through the U.S. Fed.
U.S. dollar,
the entire world economy would be sent back 300 years. It would be like doomsday.
Yeah. All right. Well, let's leave that there. Let's not make that happen. Let's everybody stay calm.
Keep spending.
And let's make sure that doesn't happen. All right. So let's go back. So the central bank also, when you read about what they do, when you watch YouTube videos or whatever, you listen to Ray Dalio, they always say that the central bank controls interest rates and they are allowed to print money. Yeah, that's what that that's probably the big key points that you hear from explainer YouTube videos. Yeah. But I wanted to talk about so how does the central bank actually go about controlling interest rates? Because they can, if by influencing the interest rate, if they lower it, they can stimulate the economy. They can make it cheaper for people, businesses, whatever, to borrow money and spend it. So it keeps the economy stimulated. So how does the central bank actually play the role of adjusting that interest rate and stimulating the economy? So
they control the amount of money that's in the economy, to put it simply. Yes. So I'll just give you an example. Say the RBA wants to lower the interest rate. Yeah. Right. So how do you lower the interest rate? You buy government bonds. And when they say the interest rate, they generally mean on the government bonds. So you're going to buy the government bonds, which means supply is lower compared to the demand. So the price is going to go up and the interest rate is going to go down.
Right. So because they're buying, so they're taking those bonds away.
Yeah, basically.
Yeah. Okay.
So what they do is say like they want to buy a certain amount of bonds. They'll go at, I think it's 11 o'clock on whatever day. They'll say, we want to buy these bonds. Then everyone sort of who holds exchange settlement accounts, so the banks and the superannuation funds and whatnot, say, yeah, we'll sell those bonds to you at that price that you're asking.
Okay.
That auction takes place. They sort of do that. And then what they do is they just say, well, say with CBA, we've just bought $10 million worth of bonds from you. We'll just put $10 million in your account. We'll just add $10 million onto CBA's account balance. Like that's what they do.
So the central bank is actually buying the government bonds off of the banks, and that then essentially clears the bonds off the table, but also gives the banks money.
Yeah.
That's how it works.
Yeah.
Okay.
So
There you go.
and it's not that different to really how a bank, like 'cause any bank can create money. CBA creates money. Every time they lend money, they're creating money out of thin air.
It's just in the form of credit.
Yeah. They're just saying, yeah, like we'll lend this money to you.
Yeah. It's an IOU.
Yeah. And then you sort of, the constraint on a normal bank is that they've got to hold capital against that, all of their operations. So they've actually got to have some physical currency. The difference,
Something to back it up.
Yeah. The difference with the central bank is they can make the currency. And so that's sort of an important distinction to make. The difference between money and currency. Money or currency, is a form of money. But
Yes.
if you look at sort of how much money is in the economy, you're going to see it listed as currency, bank deposits, and then like something called broad money, which is a little bit sort of fuzzy what that is.
Okay.
But yeah, so currency is just a form of money, and the central bank is the only sort of body in the economy who's allowed to make currency.
Okay.
Right.
So currency is like Australian dollars, whereas money actually refers to what I've got in my wallet.
No.
Is that right?
No. So what you've got in your wallet is currency. Money.
Oh, okay.
Money.
I got it the wrong way
so
around.
your money is what
Yeah.
you've got in your wallet. So like your $20 notes and
Yeah.
like your collection of coins
Yeah.
plus what you've got in your bank account. That's your money. But
Okay,
like
yeah.
part of that is currency and part of that is your bank deposit.
Okay. Right.
Right.
So, okay. Wow. Learning a lot today. This is great. I could talk about this for hours. I love learning about this stuff. Right. So the central bank is essentially buying, so to control the interest rate, they're buying the bonds they're buying the government bonds off of the other banks. And then that gives the banks money, and then the money can, go into the economy, be lent and spent and that sort of stuff.
Yeah.
That's kind of that's the broad picture of it.
Yeah.
Okay. And then, so explain again, how does that relate to, how does that then relate to the central bank just adding zeros, just printing money?
So
How does that work with the balance sheet and all of that?
So basically what happens is, we'll use the example of the RBA and CBA.
Yeah.
They go to buy $10 million worth of government bonds off of CBA. So on the RBA's balance sheet, they say, okay, $10 million of government bonds is on the asset side,
Yeah.
and we'll just add $10 million worth of liabilities in like CBA's column on the liability side. Like that's literally it.
That's the printing of money, because they're not actually, they can just buy it.
Yeah. But the important thing to remember is that in the economy, all you've done is switched out one asset for another.
Yeah.
So you sort of switched out one less liquid asset, you could say, for another one. You've advanced a bunch of interest and whatnot, but you're not just going into the banks and saying, here's some money. They are actually like switching that out. And so in general, a government bond is considered to be a very safe asset for a bank to hold. It's right up there with the highest classes of assets. The only thing higher is money. And so they're just switching that out so they have more actual money to spend. And what that does is it lowers the interest rate, because when they're settling payments at the end of the day, they don't have to borrow as much.
Yeah. Right. So when people say this whole concept of printing money, it's actually just, they're really just referencing this process that's happening.
Yeah. Yeah. They're just, it's this process of buying money, and just because of the way the central bank works, they don't have to have that money already to buy a bond. If they want to buy something, they just make the money, basically.
Yeah, exactly. Yeah, they just add zeros in there.
Yeah.
They just press their keyboard 000.
Basically, yeah.
Exactly. Yeah. Okay. Wow. So I wanted to talk. So it's a fine line. So they've got to try and be, I guess, kind of independent. Although they're kind of working with the government, the central bank's trying to be independent. They're trying to control the currency. They're trying to control the amount of money and credit in the economy, as best they can. What happens if they start going a little bit berserk? So what happens if they just all right, like what we've been seeing, I suppose, over in the United States, where people are looking at the Fed's balance sheet and they're buying, literally, trillions of dollars of these bonds. And what happens if this starts to get out of control and, the central bank starts to get a bit too trigger happy and they just keep buying and buying and buying?
Well, at some point, if the banks just think, hang on, this is crazy, I don't actually need any more money, like I'm quite happy with how much we've got, like this is fine, they'll just say, I'm not going to sell the bonds I have, sorry. And
okay.
so there is that sort of hard limit of what the central bank can do. Right. Like if nobody wants to sell their bonds, the central bank can't add money into the system.
Right. So although we say technically, the central bank can just print as much money as it wants, I mean, technically, yes, it can do that maybe by the rules, but in reality, that's not true.
Yeah. I mean, I think they could probably find a justification for just saying, well, you don't want to buy the money, you don't want to sell us the bonds, we're just going to give you the money anyway. They could probably figure out some justification for doing that, but that would be, like, we've never been in a situation where people have stopped taking money, so we don't know that.
Yeah.
And then the other part of it is, like, for example, early this year, everyone went into a bit of a flurry when the Fed said they were going to do unlimited QE, which is just the buying of assets in the market. They said they were going to do unlimited QE. Basically, what generally or historically QE has done is they said we're going to do $600 billion or $1 trillion or whatever.
Yeah.
And then they do that and they stop. And then they see what happens. In this case,
time was different.
This case, they've just said, look, we're not going to put a limit on it. We're just going to do it until we see that our goals have been fulfilled. Everyone suddenly thought that they were going to put unlimited money into the economy, which wasn't true. They put a certain amount into the economy. You can go and see how much money they put into the economy. Like, they didn't actually put unlimited money. And it's kind of based on this principle that they learned during the GFC, where they were putting sort of numbers on it.
How much they're going to put in.
And then it turned out to not be enough. And then they had to come out again and say, okay, well, now we're going to do another round. And that just erodes the credibility of what the central bank is doing. Like, it starts to look like the central bank doesn't have control of what's going on. They look out of control, and that causes more panic, which makes the situation worse, which means they need to do more. Right. And so back in the GFC, this is sort of the fiscal side of the GFC. Is a guy, Hank Paulson, he was the Secretary of the Treasury under Bush during the GFC. And he was asking Congress for $700 billion. And they were like, you're mad. Like, we're not giving you $700 billion. Like, he was asking for a blank check of $700 billion to go and do what he wanted to save the financial system. And they were like, no, you're dumb. We're not going to, like, why do you need so much money? And his in Congress, he was testifying and he said, if you show up to a gunfight and you've got a bazooka in your pocket, you may not have to take it out and use it if the other person knows you've got a bazooka.
Yeah, that's smart. Yeah.
So he was saying, look, we might not have to use the $700 billion. We don't want to have to use the $700 billion. But if the market knows we have it and we have the ability to backstop all this panic, they might just stop panicking and say, oh, it's fine. Like the government's got us. We're going to be fine.
$700 billion.
Right.
Wow. Yeah.
So that's kind of like, and that $700 billion, they did end up using it. And they actually made money off it because they went and bought a bunch of bonds. They injected equity into some companies with like interest that had to be paid, and they actually made money on that.
There you go.
Wow.
But yeah, it's this, when central banks, what they've learned now is that if they put out big numbers that they think are going to backstop the economy, they may not have to use it because people just stop panicking just because they said they're willing to do it.
Right. And I guess is that kind of what we're seeing at the moment with the stock market, how as soon as that kind of sentiment was coming out that there's going to be unlimited, or I guess there's no end to the quantitative easing, the stock market has just been on an absolute tear. It's kind of in a case where a lot of people don't want to bet against the amount of money that the Federal Reserve is spending on financial assets. Is that accurate? Or not?
Yeah, look, I don't think we're going to know 100% until we do a retrospective what's happened here. Like we're still in the middle of it. I think that there was a fairly significant worry that there was going to be a financial crisis, similar to what we saw in 2008, which never ended up happening. And I think that the panic there was that people are going to start defaulting on their mortgages and on their car loans and on student loans and all those sorts of things. And that was going to spark a financial crisis. Because this is something that people get confused, is like a recession and financial crisis, because they're used interchangeably in 2008. They think they're the same thing, but they're not.
Right. Okay.
A financial crisis is the financial system failing. And that's what happened in 2008. There was... and I think this is the unfortunate thing with like a lot of people have watched The Big Short and think that's the extent of what was happening in 2008. It's a misunderstanding of what Michael Lewis was doing. Michael Lewis wrote the book that The Big Short is based on as a character study of Michael Burry.
Right.
And what Michael Burry did and like who he was. And that's what Michael Lewis does. He wrote like Moneyball was about this crazy guy who went and managed a baseball team and did this like radical new thing with the baseball team.
Right.
Like that's how Michael Lewis writes. He wasn't trying to explain the financial crisis, basically.
Right. Okay.
There was a lot more.
That's just the way it got interpreted.
It's because it's like sort of the best explanation out there.
Right. Maybe the easiest to put into a book.
The easiest. Well, I mean, there's been a lot of books written about the financial crisis. There's others that are, like actually explain what happened. But that one was just, it's very, I mean, Margot Robbie in a bath explaining economics to you. I mean, like I'm all there for that. But
but maybe won't give you the most detailed, precise.
Look, it's a slice of what happened, and you've got to understand. Like Michael Lewis works at Solomon Brothers for Louis Ranieri, who's like, I don't know if you remember at the beginning of the movie. There's the guy who walks into the room at the beginning and is like, "Who wants to make some money?" And it's like this big like fat guy. I think he's got suspenders on, and it's kind of the story of like. Solomon Brothers invented this way of packaging mortgages and then they sold them. And when that was happening, Michael Lewis was working at Solomon Brothers.
Right.
And he didn't fit in. He didn't really enjoy working on Wall Street. He thought it was all a bit disgusting how they were making all this money, not really doing anything. And so he sort of got he's got that background to him. And so when he wrote that, he was showing, look, these guys did a really bad thing. It was really terrible. They were basically crooks, but there was a large structural issue within the financial system, where basically nobody knew what anybody else owed anybody when it came to derivatives. Like these banks were doing these giant derivatives trades worth like hundreds of billions of dollars, and they were writing them down on like paper, and they were in some back room for some low-paid secretary to go through and enter into the books. And everyone accepted this until those derivatives started going bad. And then everyone was like, oh my God, I don't know who owes what. The banks didn't know what they owed anyone else. They didn't know what was owed to them. And all of this was blowing up.
Everyone just lost track of everything.
Yeah. And so, and they knew this was an issue. They knew before, and they were trying to fix it. Like Kevin Rudd, when he became prime minister in 2007, he knew that this was an issue, and he actually went and met with the Secretary of the Treasury, and that's part of why Australia was so sort of isolated from it, and why he was so ready to pounce, because he knew it was coming.
Right. Okay.
Like he sort of foresaw that there could be an issue there. But yeah, basically nobody knew what anybody owed, because they were all like in these back room, like sort of like these pieces of paper, and they had to sort of try and net them all together, and that's why it all exploded.
Maze of sticky notes.
Basically, yeah. And look, it's happened before, and like literally 100 years earlier, there was a similar crisis that happened, the Panic of 1907.
Right.
And this, like, basically it's weird how similar the crises were, where one bank failed, the whole thing went bust, and then JP Morgan, the guy who started the JP Morgan Bank, had to be sneaked into New York City to come and save everything. And they had to sneak him in, because if he was away at some like church thing, he was very religious.
Right.
And if people saw that he was coming back to New York, they would know that the panic, like there was something seriously wrong, and that everything would have gone bad. And it was after 1907 when that happened that they set up the Federal Reserve.
Right. Wow. Okay. There you go. Wow. What a history. What a history lesson.
Yeah.
So should we keep talking? Do we need to cover more on central banks? I think we've kind of gone through it.
I think the only thing that we haven't really touched is what's called unconventional monetary policy, which is becoming front and center now. So things like negative interest rates, like negative interest rates and QE are sort of the things that get pushed right up to the top of the headlines. But there's two other sort of tools that can be used. There's forward guidance, which is basically like it's becoming very commonly used now. If you go to a statement made by a central bank and speeches made by central bankers, they will very sort of clinically lay out, this is what we are forecasting. This is when we're going to change policies. So when, for example, they cut rates all the way down during the crisis, they said rates are going to stay low for a long time until we see a recovery. And so that gives the market and the economy some confidence of where policy is going to go.
Yeah. And
that hasn't always been the case. Like back in the 1970s, 1980s, the central bank wouldn't release a statement or anything when they changed their policy. They would just do what they were doing. And it was kind of like they were just doing their thing. And then someone figured out that, hang on, if we tell the market what we're going to do, we might not have to do as much. And so that's, forward guidance is becoming very, very commonly used. And Philip Lowe, the governor of the Reserve Bank of Australia, is a very big fan of central guidance. Like he's written, he's part of like sort of the economic research team. I'm not quite sure what the official name is, at the Bank for International Settlements, which is basically the central bank for central banks. It's in Switzerland, and he's on their like sort of one of their research teams, and he writes a lot about forward guidance. And then the last one is term funding facilities, which is basically different way of injecting money into the banking system specifically in order to stimulate lending. And so here in Australia, we've seen a term funding facility be set up during COVID, where they said if you, they made, I think, $90 billion or $120 billion available to the banks, specifically for lending to small business. So if they basically said they would use, I think on a month, like blocks, if they increased their lending to small and medium businesses by like every dollar they increase it, they would get given $5 by the central bank.
Right.
And so that's a different way of injecting money into the economy. And basically it just trying to tell the banks you need to lend to small businesses.
Yeah. Just a slightly different structure, slightly different incentive way of doing it, I suppose.
Yeah.
Yeah.
And so we saw those things sort of start to be used in the 2008 crisis as well. And then straight away when this crisis happened, all the central banks just said, term funding facility, here you go, small business lending.
And just to wrap up on central banks and whatnot, I've heard a lot of news articles and videos lately talking about, the central bank steps in and does their thing and, buys the bonds and prints the money. And that causes a hell of a lot of inflation. And people are, economists or whatever, are worried about inflation. Did you want to just quickly explain, because inflation is one of our three big, I don't know what we would call them, outputs, economic outputs. So how does what the central bank does influence inflation?
Look, you ask three different economists, they're going to give you three different answers.
Right. Well, what's your take on it?
Basically,
or generally, the easiest way to explain it.
The idea is that the more money you have in the economy, the more economic activity you have, the more prices are going to rise, because it comes back to this idea, it goes back to the 1930s of this guy called John Maynard Keynes. You may have heard of Keynesian Economics.
Yeah. Heard of it, don't know what it means.
Basically, he writes a couple of books in the 1930s saying that the economy has sort of a maximum productive output.
Okay,
And so if everyone's working, if there's full employment, if you've got the best technology being employed in the best ways, there's this maximum productive output.
Max of the max.
Yeah. There's sort of this level of output. GDP isn't necessarily going to be that level. GDP is more going to be determined by the demand in the economy.
Yes.
So if you increase demand and the demand goes above the sort of potential output is the technical term. Demand goes above potential output, you're going to start driving inflation, because instead of all the firms and factories and whatnot increasing their output, they're just going to start increasing prices because they can.
Prices go up, and
because
so the demand is there.
Yeah, and the demand is there. And so what you have is, if you're increasing demand by increasing lending, increasing the amount of money in the economy, so lending increases, et cetera, the fear is that you can sort of push this, the demand past the potential output, and that will cause inflation. In practice, we've had unprecedented amounts of money printing in the economy, and inflation has been very sluggish. And the reasons for that, that's the current issue in economics. Someone's going to win a Nobel Prize for figuring it out. But there's kind of a bunch of different theories. One is we're buying a lot of stuff from overseas very cheaply. And so inflation is staying low because of that. Inflation is an imperfect measure because we're buying, the way you measure inflation, or the traditional way of measuring inflation, is a basket of consumer goods, like the typical basket of consumer goods. And that may not capture where inflation is actually happening in the economy.
Yeah.
There may be some in some industrial sector, there's maybe an industry, for example, inflation is going crazy and that may be constraining economic output there. And obviously if we're just buying everything from China, it's much cheaper, inflation is going to be lower.
Right.
That's a factor as well. And so nobody really knows what the real reason is. And somebody's going to win a Nobel Prize for figuring it out.
Oh, okay. Right. Seems complicated.
Yeah. And the problem with economics is that you can approach it with a very scientific viewpoint, but you can't do experiments.
Yeah.
Right? So in physics and medicine and chemistry, you can set up an experiment, do it, repeat it, do 1,000 trials, whatever. You can't do that in economics. So
I guess you just learn from history what has happened, I suppose.
Yeah, exactly.
Yeah.
And prior to the last 70 years, economics has been very different because prior to the last 70 years, most countries have been involved in some major war pretty much consistently. And so they've got a very differently structured economy because they've got to make tanks and ships and whatever for their for their army. And if they don't do that correctly, their country isn't going to exist anymore. And so you see that in the Second World War, they spent an ungodly amount of money trying to ship things over in Britain, trying to ship things over from the United States.
Right.
Because just to feed people, they had to ration food in the UK until the 50s because they just didn't have enough food for everyone. So everyone got a little book and you were allowed to buy one package of bacon a week and one pound of butter every week. There
you go.
And so and they literally considered in the Second World War going and taking people's jewelry and wedding rings and things and melting them down and sending them to the US to pay for the oil and the weapons.
Oh my gosh.
Yeah. So
that's crazy.
So we've got this totally different paradigm in economics now compared to 70 years and 70 years ago and before. And so there's a lot of stuff we just don't know.
Right. Well, I think we should probably start wrapping up the podcast. We've already been going for well over an hour.
Yeah.
So I think the last thing we should probably touch on is just we've talked about so much stuff, the inputs, the outputs, the fiscal policy, the monetary policy. There's so much stuff that we've covered. For the average person that just wants to kind of learn how to track the economy, how our economy is doing, how the US economy is doing, wherever you might be, what are some things, some takeaways? What can people actually go and look at to see how our economy is chugging along?
So obviously looking at the big three outputs that we talked about, you're going to find those. Every time something like that's released, you're going to see it in the media. But those things are fairly infrequent. I think in Australia, we do a quarterly inflation series. We do monthly unemployment and quarterly GDP. And even GDP, I think it takes 7 weeks to produce. So the course is going to end and then 7 weeks later, you're going to get the GDP data. So that's very sort of infrequent. Other things you can look at are things like construction numbers and housing starts. So how many houses how many housing approvals were issued in the last month or last week or whatever.
That makes sense.
That's a good indicator. Visa and MasterCard publish spending data quite a lot.
Yeah, we were talking about that not too long ago.
Yeah, so they just publish this is how much people spend. And I think they even break it down into what categories of things people are spending it on.
Right.
There's a lot of the banks do similar releases, and they also do like business confidence surveys. And so they'll call up a bunch of businesses and ask them a set of questions, and they'll put a number of what is like business confidence at the moment. And then the last one is this thing called like manufacturing indexes. And so these are actually quite useful to look at, where they're very complicated numbers to put together. But effectively the way it works is if it's 50, it means that compared to the last period, manufacturing has stayed the same. If it's above 50, it means it's expanding. Manufacturing is expanding. If it's below 50, it means manufacturing is contracting compared to the last period. And
that'd be a good measure.
Yeah, they're a very, very good measure. And so there's a few of them out there. Like you're sort of, if you just search manufacturing index, you'll get the big ones. I think the big one is, I always mix it up. So there's the Australia Manufacturing PMI, which is put together by AIG. And there's like American ones as well. And then like basically the way it's put together is they are looking at how much raw materials are these companies buying. And that's a good indicator of how much is being manufactured. And so, there's like currently in July, the Australian PMI was at 53.5. So it's expanding. Compared to, and that makes sense because domestic manufacturing is going to go up because they need to make toilet paper.
Very good point.
So there's that stuff. So ComSec have a very good weekly report where they will put all the releases that are going to come out in the next week. And they will, so they do two reports. They do one like after the week's done to say what happened. And then one looking forward. So that all the releases that are going to come out in the next week. And then what the expectation of what they're going to be and what the last reading was. And so, and you can just get to that through, you go to like the ComSec site, you've got to have an account, which is free to make. Log in and you go to the research tab and they'll have all of those things there. So they do that. They do a weekly, like 3 times daily, they do a podcast, which just sort of reads out like what's happening, more market focused. And then daily, they also do sort of a little bit of a write-up about the major releases during the day. And then the other sort of major source, I would say, is looking at central banks, because they're a very good way of getting an idea of what's happening in the economy. Most central banks will meet every month. Here in Australia, they meet every month except January. I think in the Fed meets like 8 times a year or 9 times a year. And they will release a statement after every meeting. It's basically saying this is what we think is happening in the economy and therefore this is what we're doing. And then later on in the month, they'll release the minutes from the meeting. So that's much more detailed. And then just Google stuff you don't know. Like if you don't understand like what this measure is or what that means, just Google it.
Yeah. Awesome. Wow, what a podcast that was.
Jam-packed.
That was really jam-packed. Hard to follow some because my brain is just mush when it comes to economics. But I think you explain things really, really well. Like I've got such a better understanding of how things like the central bank actually works and how they actually go about what they try and do. So no, that was awesome. Thanks for coming on. You can come on anytime. That podcast was easy for me and Hamish.
Yeah, absolutely.
Just ask a couple questions, kick the feet up and listen and get educated.
Yeah, well, I mean, it's like, especially central banking is it's a very weird thing. And it's very difficult to get your head around. Like I've read at this point, probably tens of thousands of pages on central banks. And I still have to sort of like sit down, like if I'm trying to think about a concept, I have to sit down and maybe like sketch it out and like try and understand it. Like it's not a thing that sort of clicks with our brains very easily.
And there are so many parts to it too.
Yeah. And so like, yeah, I mean, I've like I said, I've read like hundreds of books. And yeah, it's still just a very weird thing, and it requires quite a bit of mental energy to get your head around it.
Yeah.
But I find it so interesting. I mean, what we've talked about today, you know, when you just go down to the shops, or maybe you want to send your friends some money and they're with a different bank to you, now you understand kind of a bit more of the back end of how that actually happens.
Yeah.
So
there's a very good podcast. I think I recommended it to you, Brandon.
Yeah.
The Vergecast did an episode last week about how money and payments have become social media. And it's a very interesting sort of case study of Visa and how Visa was started, and how the guy who started Visa actually sort of had the idea for Bitcoin long before Bitcoin was invented.
Right, there you go.
But didn't.
Oh, what a missed opportunity.
Well, he just didn't have the technology to. And he's still like a titan in Silicon Valley. Like every time a new payments company comes up, like if they can get a meeting with him, like it's a good sign.
It's a bit, big up. Yeah.
Yeah.
Oh, very interesting. Well, thanks very much for coming on, Jason. We really appreciate it. And
no worries.
Thanks for taking the time out of your day and doing all the prep work, because we're small brains. You're the big brain.
No, I listen to the podcast every week. It's really good.
Oh yeah, thanks for tuning in. Yeah, and thanks for joining us. We're going to have to do a part 2, because there's still so many topics we haven't even touched on that we were hoping to get to today. But yeah, thanks Hamish for coming along as well. Enjoying the ride.
Yeah, absolutely. It's been great.
Yeah, it has been. We've just been able to chill out for this episode.
All right, well, Brandon, I've just got one question for you.
Oh gosh, here we go. Yeah.
Should I buy Tesla stock?
Oh, look, you've got to. I mean, my sole reasoning for it is that it's gone up by 100% in the last 2 weeks. So surely in the next 2 weeks it's going to go up another 100%.
Yeah, I think that's how it works.
That is how it works. I'm pretty sure. I'm pretty sure there's a rule somewhere that says if it goes up 100%, it's going to keep going up.
That's the official The Young Investors podcast position as well. By Tesla.
Yeah, that is. Yeah. No, it's not. Jeez, do not sue us, for Christ's sake. Well, my last question to you, Jason, is who's going to win the Formula One this weekend?
Oh, that's not even a question. It's definitely going to be George Russell.
George Russell. Go George. Up the George Russell.
Yeah.
It's definitely Valtteri Bottas or Lewis Hamilton. Flip a coin. It's one of those two guys.
Well, we might get some rain, so.
Oh, there you go. Maybe we'll see Supermax come out.
Yeah.
Anyway, off topic. Thanks, guys, for listening. We super appreciate it. Thanks, Jason, for coming on and joining us this week.
No worries.
And we'll catch you guys in the next episode.